Now the topic before us is computing the money multiplier. We have already learnt that money multiplier represents the factor by which the initial deposit can be multiplied to arrive at the money supply in the economy. So now the money multiplier is typically means generally a number between 1 and 10, but it can vary depending on the reserve requirements set by the central bank and the behavior of banks. Now, what is the formula for calculating the money multiplier? Money multiplier is obtained by this formula 1 over reserve requirement ratio. What is the reserve requirement ratio? Reserve requirement ratio is the reserve ratio set by the central bank. Suppose we deposit $1,000 in the bank. You all of us know that the central bank have two basic functions. First, to accept deposits, and the second is to give loans. When this first function has been done, that is the deposit has been obtained, then the banks cannot give all this amount on loan, because as per the directions of the central bank, the commercial banks have to keep certain percentage of the deposits as reserves, that is in cash or as deposit with the central bank. Normally the reserve ratio is 10% of the deposits. So the banks can say give $900 after keeping $100 as reserve. They give $900 as loan. So this is the reserve requirement 10%, which is set by the central bank. Suppose reserve ratio is 20%. So here we can calculate the money multiplier as 1 over reserve ratio, that is 1 over 20%. When we are writing 20%, it means that 100 comes above and 20 below. So the answer is 5. In the same way, if we say that the reserve ratio is increased from 20 to 25, in that case it becomes 1 over 25%, or in other words 100 over 25, and the money multiplier comes to 4. In this way we can calculate the money multiplier by this formula 1 over reserve ratio, which is set by the central bank. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.